All right, well, my next guest says that we are on the edge of the worst financial crisis in over 300 years and is predicting the Dow Jones Industrial Average could reach a low of 2,000 before things get any better. His name is Robert Prechter, and he is the president of Elliott Wave International, which publishes analysis of global stock, bond, currency, metals, and energy markets. Robert has been publishing the Elliott Wave Theorist, a monthly forecasting publication since 1979. He also has 13 books to his credit, including the New York Times bestseller Conquer the Crash: You Can Survive and Prosper in a Deflationary Depression. The book was originally published in 2002, but was revised and updated in 2009. Robert, it's an absolute pleasure to have you on Follow the Money Weekly this week.
Well, first of all, I want to congratulate you on the growth of your show and the success of it, and I'm happy to be here.
Thank you, Robert. You know, September has been an interesting month so far for the equity markets. There has been a lot of uneasiness on the part of investors as we were heading into September, even among many financial commentators who felt very uncertain about how the market would fare. Of course, so far this month, we've seen a nice rally. Some of the indexes are breaking even some important resistance levels. So to me, it seems like this rally is bizarre, but it's also unsustainable given the economic realities that are facing us. What's your research telling you, Robert, about what's driving this rally? What's behind it?
Well, the first thing that tipped us off to an up to September was the fact that the idea of a down September got so much ink. It was in all the newspapers, September's the worst month, get ready, get ready. And so the market went down in August anticipating that. Some of the figures that we follow, for instance, the percentage of bulls on the S&P, got to fairly low levels in late August. But that has completely changed. This rally has a classic counter trend shape from the model that I use, which is called the Elliott Wave Principle. It's a two-step rally, counter trend. But the most amazing aspect of this rally is how much optimism has been generated just in the last 3 weeks. There are some indicators that have gone to historic extremes, some that are near multi-year extremes of optimism. And most people don't see that. We keep hearing people talking about how gloomy everyone is. They are confusing bad fundamental news with gloom among investors. They're completely different. You have to follow the indicators that tell you how people feel and what they're doing in the market to understand whether they're too bullish, too bearish, or somewhere in between. And right now, they're way overly optimistic. I think that portends the end of this rally within a matter of days.
Robert, my analysis tells me that we are going to experience probably a brief period of deflation, possibly even severe, but that it will be followed by a much larger period and longer period of inflation caused through basically poor monetary policies that are attempting to fix our broken economy. And this brings me to the ever-widening inflation-deflation debate. I think most of our audience understands why future inflation could be a reality. But as the subtitle of your book suggests, you foresee America heading into a great deflationary depression. Share with our audience why you believe that America is heading into a period of rampant deflation as opposed to inflation.
The main argument I made in Conquer the Crash is that the amount of outstanding IOUs, which is in the hundreds of billions, trillions of dollars when you include the derivatives, is far too much for even the U.S. government to handle or the Federal Reserve to handle. Most of those IOUs will not be paid off. The corporates are in trouble. The lower-end corporates, which people are buying hand over fist right now, the high-yield bonds are the worst bet on the board. And the amount of credit that has expanded over the last 3 decades on top of the previous 5 is unprecedented in human history. Credit is virtually always liquidated through default. We've seen plenty of defaults coming in the real estate area. We've had people who owe credit card debt go bankrupt. I think we've already seen the initial effects of deflation because we've got some key markets such as the stock market selling at 1/3 its former value, real estate selling at 60% of its former value, oil half of what it was selling for at its peak. So we're seeing, in my view, the early stages of a deflationary trend. But the market, the stock market here, has built the largest top in the history of finance, as far as we know, 10-year topping period, starting in 2000, peaking out in the middle in 2007, plus or minus a year, and finally now at a lower high out here in 2010. If you step back and look at that chart going back 30 years, you'll see the most beautiful head and shoulders pattern you've ever seen. It fits the volume characteristics. In the last year and a half, volume on rallies has been light. It has picked up on declines. And each one of those peaks, 2000, 2007, and now, has had some pocket of a market somewhere that has enjoyed the reflationary run-up. In other words, a mania or a bubble. And we saw that in 2000 with the NASDAQ when everybody was going crazy there. In terms of gold, Dow made its all-time high in 1999. That's never been approached. In fact, it's down 84% in real money terms. And in the middle peak, we had three more manias. We had the real estate mania topping in 06, the Dow in 07, and commodities, especially oil in 08. And here in 2010, we've got sort of an echo of it. We've got a few things at new all-time highs, which people are pointing to as leading the way toward more inflation. But I think if you look at it and realize how few things are at new highs here, you realize inflation is starting to lose the battle. And those things are Canadian real estate, pork bellies, which just made a new all-time high, and gold. But none of the other precious metals or metals are at a new high. I think this is the right shoulder, and when it's over with, when this optimism that we have right now in stocks and in junk bonds fades, I think you're going to see the final capitulation of this whole house of cards.
Even in your May issue of your newsletter, The Elliott Wave Theorist, you made a very bold statement by saying the current bear market will be the biggest in nearly 300 years. You also recently stated that your research was telling you that the Dow Jones would be heading south and could bottom out at around 2000. You're basically painting a portrait of a coming financial Armageddon. Give us an overview of how all this is going to play out from here, starting right here where we are in the present. Where do you see things heading, and what does it portend for the average investor?
Well, the Dow has already, or let's say the stock market, because I think the S&P, the OEX, the NASDAQ, and the Dow are all different components of the same thing, has already undergone its biggest bear market in over 70 years. You have to go back to 1929-32 to find a bigger one. So saying it's the biggest in 300 is only one more giant step. If we have another wave down, such as we had in 2007 to 2009, we could surpass that 1929-32 experience. And if we do that, it'll be the biggest since the South Sea bubble collapsed in England in 1720. And that was the model I was using in Conquer the Crash back when everybody felt that Greenspan knew what he was doing, had his handle on the economy, and would never let it collapse and never let stocks go down. So it's a forward-looking type of model because it's based on a fractal and the idea of waves of optimism and pessimism, which are the driving force. As for what's about to happen, the wave of optimism on a short-term basis that we've just had from early July, which I believe is peaking out probably this week or next, has been amazing. We've gotten a new all-time low in the percentage of cash in mutual funds. This means mutual fund managers have no fear whatsoever that the market's about to fall, or they'd be raising cash, as they usually do at bottoms. We had a 24% bears reading among the American Association of Individual Investors on the poll that they do. That is fewer bears than we had at the all-time high in October of 2007. We also follow momentum indicators, and the recent rally has generated a very low trading index reading of what we call the open trend, developed by Peter Eliades. It's a way of smoothing the amount of buying power going into the market. When a lot of buying power goes into a market, it either means you're in a kickoff from a major bottom, such as we had in March of 2009, or it's the exhaustion and usually a rally in a downtrend, such as we had a similar figure in September 2008. When the government announced they were bailing everyone out and they banned short sales and people bought the market like crazy, and a month and a half later it was down by a third. We're seeing that kind of reading right now. So the optimism is extremely high. It's going to be balanced by the same amount of pessimism in coming months. So I think the market has given investors three opportunities to get out of stocks in 2010. If they felt in 2009, gee, I wish I'd sold them in 07, that we've had January, with the S&P at 1150. We had April with the S&P at 1220, and here we are in September with the S&P back at 1150. It's the same opportunity you had in January, and I think probably the third and last opportunity of the year to get out.